Stocks are pieces of publicly traded companies that one are able to purchase in order to invest in hopes of seeing that stock price rise in the future in order to receive payouts through dividends if it's available at that stock, which means payout from the stock ownership of it at that higher value, or to sell the stock at a higher value and the investor to make money on that difference. Bonds are a temporary loan that the investor provides to the company in order for the company to pay back the investor with a higher amount of money in the future, and the investor therefore making money. Equity funds are a group of stocks predominantly with a small set of bonds where a manager micromanages the set of percentages of each stock invested in order to maximize growth at a manager expense ratio cost. Mutual funds are like equity funds, however, they have a higher percentage of bonds in the funds versus the stocks, where you need a special license to sell mutual funds in Canada. And segregated funds in Canada are a group of equity funds that we are able to put together insured between 75 and 100% at a cost as well. So what I want to talk about in this presentation today is mainly the equity funds, and specifically going through the list of equity funds, which are a high percentage of stocks, high investments, and not specifically talking about which ones to invest in or not, but just going through and observing how each one is broken down, looking at the percentages of each fund and seeing, right, what exactly, when we say we invest, what are we investing in, and how is it broken down? Are we investing in stocks? Are we investing in equity funds? Are we investing in bonds? Or are we investing in mutual funds, or rather equity funds and segregated funds? And the answer is all of the above except mutual funds in Canada. So what I wanted to do is I wanted to go through this with you and make this video. And if you wanted to make an appointment with me, I suggest you go to my website, which will be portrayed below. And what you can do is you can schedule an appointment with me. Here's my website. You can click here, schedule an appointment, and it'll come down straight to schedule a complimentary no obligation appointment with me. First name, right? Put your first name, last name, email address, mobile phone number. Just to scroll up, I do want to show a little bit of my website, right? Financial Independence. You can actually download concepts here if you want. Here's a video I put here, the high cost of waiting.
Let's talk about the high cost of waiting.
So that's one I want you to see. And if you want to actually book an appointment with me, you can actually go to my Calendly, which is right down there. The link will be down there. You click on the 1 hour free financial needs assessment, and you can click your booking appointment with me, and I'll get back to you. And we will start a 1 hour completely free financial needs assessment with my supervisor in Canada, Paxton Fritsch, Executive Vice Chairman in World Financial Group, and in the United States, Andy Pham, a Senior Marketing Director out of Irvine, California, who will be my mentors and will lead the presentations for Canadians and Americans, which is very exciting as I'm able to help both Canadians and Americans. So what I want to do in this video is really get into the funds and just kind of take a look at what are these funds? What is these equity funds? What does it mean? What are the stocks, right? So what I want to start saying is that I'm not saying which ones you should invest in this video. I'm just saying that these are just certain ones that exist. I'm not providing any financial recommendation of which ones you should invest in or not. That's what my supervisor, Andy Pham, and Paxton Fritsch, with over 13 years experience for Andy and 15 years experience with Paxton, will do in our meeting. I'm not trying to say that I'm the mastermind of which stocks and equity funds to choose and at which levels of segregated funds, right? The point is growth, and what we want to look at the 10-year or more growth, right? Because it's not when you're in the market, it's how long you're in the market should make success for you, right? Because through time, right, over the past 10, 20, 30 years, there's been up and downs, but if you put money in, it's always been positive, and the future is exciting, especially with technology. I'm not talking technology stocks. I'm just talking technology and the ability of, we're at the moment we can do anything in this world, and I really, I don't see, I can't imagine just complete market collapse at the spiritual level. We're all like, it's all solid. Our future is good. at the spiritual, I'm just looking at the past, right? Like the past 30 years has been up and downs and crashes, but it's all been positive. So if you got to look at the 10-year, right? So what I wanted to talk about, right? If you look at the 10-year, most of these are like quite high, 10, 11, right? Just going through, like, we have like U.S., American, Canadian, right? Like if you consider, we can even go, oh, like this one goes all the way back to 2021. Let's try it. Let's try this all in one balance, right? This is from Fidelity. Here, let me show you. Let me show you how to get here. So from Fidelity, I'm going to start with the Fidelity CA website. I have the American website here, fidelity.com. These aren't the creators of the funds. These are just they represent quite well. So let's go here. So you go price performance. So you want at a glance short term. You want long term. So you go here, boom. It pulls up the list. If you go to Fidelity Investments, this one I'm actually not too entirely certain, but I think it might be in portfolio. This might be locked. Okay. I should have checked this, but you know what? Here we go. ETFs, mutual funds, ETF stocks. Funds. Okay, I don't know the American one too well, so I guess you have to search through it. But so the Canadian website is excellent because click price performance, go long term, and so these will have the American funds in them, right? So these are the Canadian ones. But what you see here, U.S. equity funds. Boom, here we go, right? So here's the US ones. I just wish we could gone to fidelity.com to get this website, but it's okay. We have it on the fidelity.ca. It's easy because this is just information, right? Global information. They have global ones, right? Asia Star, China. 10 years, all positives, right? These Europe's have been still positive, right? And I'm sure you look at these percentages like, wow, those are pretty good percentages. It's like, yes, compared to what banks are offering, which are not close to this. So let's just grab, sure, Canadian balance. That sounds nice, right? I'm not an expert. 10-year kind of low, 5-year, but let's just see. Let's just do this this is the point of the video, right? Canadian balance fund, let's learn about it. So you see through time, from year 2000, this is that's total fund. All right. I guess that's a hypothetical scenario. Yeah, it's a hypothetical scenario of growth. So this is the trajectory of growth. So what you do when you come here, what I do is you can look at this. You can look at the Canadian bonds, equities. This is a little conservative, high in bonds, pretty high in bonds, pretty conservative. That's why the growth isn't that high, at like 5-6%, whatever it was, 5.62, 10-year. So okay, it's really cool. You can see the portfolio managers, right? You see who manages. These are the people that manage it. So what we do is like World Financial Group, we set up a group of these funds into a segregated fund. It's for the Canadian part. I'm gonna start with the Canadian part, and then with the American part, we do the same, but they're not into a segregated fund. We put them into, depending on what you need in your life, like an IRA, individual retirement account, right? Or even if you have a large amount of money, you can get like indexed, like an indexed universal life, which means that gives a little more protection where you don't get negative market years, but you get maxed at like 15%, like the ceiling's 15 and the basement's 0. If you put a $25,000 investment into the Roth IRA or the indexed So you need a large capital up front. In the United States, you're able to do that, but in Canada, you're not able to do that. We don't have the index. We don't have the Roth, mainly due to the United States insurance companies have a large value of fund money, emergency, right? At least 6 times the amount of all policies, which is very high. So, but Canada does not. But what we're able to offer is a segregated insured fund between 75 to 100%. But we usually take the 75 because it's cheaper, right? Well, we're not in the market to go conservative. We're in the market to go, like, we don't need to buy 100% security on our investments because we know they're going up through time, 10 years, and at least we're in it for the long haul, right? And it's like buying too much. You're like over-insuring it, right? We're in the insurance business. That's what we do. We nail the right amount of insurance and investments and your life insurance and your everything for how long term or permanent. So here we go. So this is nice. Has financials. That's not interesting. It's not interesting enough for me. I like the details. I like the juicy facts. So you go here to the fund. Okay. So go to the fund. What I do is scroll all the way down. I click fund facts. Right. So fun facts, you download the PDF, then you open it. Let me just change scenes. So here we go. This is the fund. I don't know anything about this fund. I don't recommend this fund. I don't know anything about it. All I know is a little conservative, right? In terms of growth. Bonds, right? Bonds and stocks, right? We started the video talking about those essential differences. Stocks a little more for growth. Bonds a little more conservative hedging. So here we go. Okay, so we have a Canadian bond fund. Wow, that's so it's a very secure. This might even this is like almost like a mutual fund, if I may say that. I mean, I'm not an expert on what that delineation is, but it's very high bond. CP, Canadian Pacific Railway, right? So this is cool. So you can go down and see. You can see exactly what you're investing in. This is why I wanted to make. This is why I make this video. You can see exactly what you want. See exactly risk, low and medium, right? I'm very new to this. I'm not an expert, and I was able to identify this is a low risk, high conservative fund. So here we go. Look, you can see year by year, and it's so like this is so. It's really dependent on the industry, these year-to-year things, because you see some go up and down. Some years are high, some years are low. It really depends on the industry of what you're investing in. But so if you pick this fund, you don't pick just one fund. What we do is we usually go 4. Depends. You can do 4 funds on a sheet, but we don't. What we want to do, we want to limit. We want to make the micromanagement of the funds, of the stocks in the fund level, where these ladies and gentlemen here, we're doing that we pay. Oh, where'd it go? Did it download? Whoops, I gotta go back. Right? Yeah, I gotta go back. Where these fine, stellar, okay, these are all men, right? They are doing the management. And so that's the beauty of, I think that's the beauty of also World Financial Group, is because these are the masterminds of the pick. And if you look at the MER, so management expense ratio, it's not too expensive. Usually most management expense ratios are between 2 and 3%, usually 3%, like below 3%, let's see, which is not too expensive overall, right? 2.06. See, conservative return and conservative price. If you were to ask me if you want max growth, I wouldn't recommend this, but it's very stable. It's a very stable one. This could be a diversified one. This fund could be, I'm not an expert, I'm not recommending this, what I'm saying might be completely wrong, but this fund could diversify your high risk funds in your portfolio of like 3 or 4. So let's go back to the website and let's look at another fund, because it's no pun intended, fun to do. So what I want to do, I want to show some American markets and some Canadian markets. Let's go. Let's get a Canadian fund. We did that was a Canadian fund, right? That we looked at, yeah. Let's do like a high tech one if we can find one. American Equity. I don't know what this is. I don't know what it means. Okay, so healthcare, financials, IT. Okay, so this one's cool. See, look at this. Look at these equities. This is a high. What's the return? What's the rate of return? The 10-year 11.7%. Here we go. This is now we're talking. Here we go. 87% foreign. Wow. So you want what you wouldn't you really want to diversify obviously your foreign, Canadian, and American because it goes up and down 3 times. So here we go. Oh, one man. This is the man. He's the man. I'm not being sarcastic. He's definitely the man. It looks like it's managed by him individually. So let's see. Let's check it out. So here we go. So an American. No, I guess it was. Yeah, I guess it's American. We got to double check because foreign also means American on the Canadian website. But this is an American fund, right? So 2.22 still not too bad. Microsoft, number 1. So if you hate Microsoft, if you don't like these companies, right? Like Aon, whatever, I wouldn't recommend this. But I mean, you have to think big picture. But I'm not saying there's things I'm against, right? I'm not saying I'm against any of these companies, but what I'm saying is this is cool that you can go in and look. This is what I want to do because it's like, okay, what are you investing? What are you actually investing in? It's like, well, this. And so we can see these medium, right? A little higher tolerance. I'm not saying that this is the fund that I would recommend, right? This is just one of them. Look at this. Alimentation Couche-Tard. That's really random. That might be in France. I don't think it's in Quebec. It's really random. It's like a late night food store in France or something. Anyways, so it says up here healthcare. I don't know where the healthcare is here. Maybe these yeah. Maybe they have like a long tail. So the total number of, they do 38 investments. That means there's 28 companies that are exactly, it's super diversified. The top 10 only represents 47%, which is not, that's an extremely diversified fund, which might be explain why it's medium, which might explain why it's done so well relative to the other American and US markets. So yeah. So let's see. Remember I was saying the years were random. Remember the previous fund had a negative in 2018, and here it has positive and negative in 2016. So this one is 2020. Let me show you a fund. I was looking at a fund. Where was it? This one. Yes, this one. Fidelity Greater Canada Class. Remember? Do you remember COVID? Is that too far back into everyone's memory? COVID. Do you remember that? Is my YouTube video going to be banned because I said that word? Well, not anymore, I guess. Not in the year 2023. But okay, here we go. So check this one out. So the Fidelity Greater Canada Class, or another Canadian one, just because, whatever. So the reason why I picked this, why did I pick this? Medium. I picked it because I think it had a high. Let's look at yes, look at this. So remember when you go here, Royal Bank, RBC, 5%, Dollarama. I don't know why it's super successful, but I see Dollarama, I see the banks. I don't know, but check this out. 2020, 53% growth. Like that's insane. Unless this was a really small fund to start out with. at. So it has a date of initiate 2008. So you see, it's really industry dependent, right? Remember the previous one had, what was that, 2%? Let's go back to it. It's 2% growth. This one had 53. How much in this fund? 840 million. Okay, now what's the other one? 690 million. Right? No, I mean, maybe now it's that maybe it doubled in 2020, right? Right, could have, right, that trajectory, the up and down, that could have been its peak of growth. Or maybe not, like 2021, it's going crazy. Dollarama gets payouts, big revenue return. Lots of other companies here too. All the banks. Yeah, so let's go back to the website. Now let's do one more fund, maybe, just to really get it in our minds. Let's do another American fund, or we did global fund? No, let's do a global fund. China. Let's do Asia Star. 5.97. Wow, look at this one. Negative 10.5. Global Innovators, 15. Sure, let's just check this out. Okay. Right, you come down here. Mark. Good name. Oh, he's got videos. Look at this guy. Right? Look at this guy. This is what I'm talking about. This is what I aspire to be. I'm going to save this. Thanks, Mark Schmel. It's meant to be. Alright. Dang, I do want to watch the video. I can't play his video on my video now, but okay. Let's go to, whoops, where's the PDF? Here we go. Wow, 8.8 billion. You see what I mean? Like, what's really interests me is that I wonder how you could make your own fund if you really want to do the micromanagement. What we do, what I do, what Paxton does, what Andy does, we set it. We do like the set and forget it, not forget it, but we choose, or they choose funds that are like high growth, but that don't like fluctuate too crazy in terms of negative. The 10-year average is very high. Here we go, Airbnb. See, right? Everything is just so different. There's a lot of micromanagement. Look at this. There's like 100. So this is okay. This is a really good point. So there's a huge spectrum of stocks in investing. That's why I wanted to start off that introduction saying there's stocks, there's bonds, there's equity funds, there's mutual funds, there's segregated funds, there's everything. If you look at this, 143 stocks. That means he's micromanaging. Mark Schmel, he's a hero. He's being like a hero for us. What is that, 2.28%? That's not too bad. It's just one person, but probably gets a lot. Based on this micromanagement, right? We have expert ceilings, medium to high. Because of the micromanagement. If you have the micromanagement of the time of the stocks, you're able to get higher returns, but you got to be an expert. And I'm not an expert yet, which is why we use these funds. We stand on the shoulders of giants, of Mark here, to make money for you. You know what I mean? Okay, this one's a little suspect. 2019, 2020 did excellent. Wow, 8 billion. Why is there no information prior to this? When was this opened? Wow, 2017. It has $8 billion. That's insane. Right? Like, we can do that. What is that? Wells Fargo? Ooh, Wells Fargo, a little shaky. They get a payout. Look at that. Canadian Natural Resources. Crazy. This is a lot of world micromanagement. 75 US. 17 Canada. Wow, that's amazing. That he's getting 75% is American and he's getting pretty good returns. I mean, this year, 2021 is not what happened in 2022? Amazing stuff. So what I want to do is I want to go to the American website, fidelity.com, just to see if we can pull up the equity funds. I pulled up a list of the mutual funds here, which is the same type of presentation as with the Canadian fidelity.ca, right, which was here, that showed all the funds. Right here's on the American side. So this is the mutual funds. Again, I myself, we don't sell mutual funds, we sell equity funds and segregated funds in Canada. But what I want to show you that this is at fidelity.com. I also help Americans, right? So here, let's look at Fidelity Select. Let me see. This website's a little different. Let me put my screen over here just so we can see the 10-year averages, right? So let's go here, 10-year averages. Right, you got 13.75 and all this and all this. Okay, let's try this. I think I'm going to move the camera back. Okay. So it's the same type of thing, right? On the American website. So again, this is a mutual fund, so we're not sure if these are bonds or stocks. It might be a higher bond to stock ratio, but more. So I like the American website or the Canadian website. So it has, yeah. Okay, here we go. The top 10. Home Depot, Lowe's. United States, 99% United States. Is there a fun fact PDF report? Here we go. Okay, PDF. You can click the PDF of it. Okay, this is, yeah, let's do the PDF. So a little different process, right? I'm glad we went through that process. And let's show you the report. Again, a little bit different structure. So fidelity.com. It seems like fidelity.ca might be. I like the fidelity.ca report, not because it's Canadian, but just because they have a little more information. And let me see this. Right. 2021 it did excellent. The high and the lows and Home Depot and all the big box stores and stuff, and the other one that did well, so I think I also had like Walmart and stuff. And yeah, so this is from the American website, right? So this is the American one. To be honest, I think the Canadian one has a little more information. I mean, right, look at this. Easier to read. Maybe just different MER costs or what's available in Canada versus what's available in the United States. So, but the point isn't learning the funds and the stocks, is learning, okay, what am I investing in? How am I investing in it with stocks, right? Because that's really important in terms of investing, is just the ethics, right? There's the ESG now, which is like the environmental social governance, which, whether you agree with or not of the metric, you have to agree that it's at least a step. Again, I don't know the metric too well, but it could be at least a step psychologically in the right direction, even if it's abused by companies. But there's a lot of you can bring ethics into investing, which I think is essential, right? Because if not, then ethics could run rampant in investing, which could be very destructive. So this is the American website. This is the Canadian. Canadian one is nice, a little easier to see. So what I really wanted to say and end this presentation is the fact that I myself and Paxton Fritch and Andy Pham, we are managers of funds and managers of funds and accounts, and I don't know if I'm legally able to say this, but that's what we do. We're not micromanagers of stocks within the funds because one, those are financial analyst experts. Two, that's not our scale of operation, right? It's I'm learning that in scales of operations in any industry, there's different scales and levels, and that's not ours, and it doesn't make sense for that to be ours. Our level is setting up the accounts for you to put these funds that Paxton and Andy are experts in funds, and they let the financial analysts who, like, such as Mark, as we saw in the PDF, control and micromanage their stocks in the funds. So we don't stress about the stock market. We don't stress about if tech is going up. We don't stress if materials are going down, because one, we're already diversified invested, right? Two, we're in it for the long haul, because we know in over 20, 30 years the market has always been positive, and right. And I mean, not all the time, but I mean the average through time, right? And that's the point. So we don't do any we don't do any changes of funds really, or I mean we obviously we follow up and check the fund through time. Obviously, as we work with everyone daily through time, we're always checking the funds. So right. But what I'm saying is we don't make hesitant, or we don't pull their money because you could lose the growth the next day, right? You keep it in the market, not set it and forget it, but set it and let it grow. So if you wanted to book an appointment with myself and my supervisors, Paxton Fritch and Andy Pham, I would highly recommend, please, to do so for your benefit, to get wealthy, on my website. Start retiring early, start retiring young, start saving early, retire younger. Your plan,
Puts
right?
a financial difference. Louise is 25 years old and wants to have $1 million saved by the time she reaches age
Save $1
65.
million, right?
So how much money
That's
does
pretty
she
good
have to save
retirement
each
goal plan,
month,
right?
which will earn a 5% interest rate to reach her goal? Louise realizes that if she starts saving now, she will have to save $650 per month. If she waited
That's a
until
lot of
she
money
was
too, right?
40,
But we have to, so what we
25
do is
years
we
from when she
look
turned
at-
65, she would have to save
What I want to show is that
$1,680
if you can't
per
afford
month to
$650,
reach
that's
the
fine. I'm
same
putting
goal.
$100 a month.
If she doesn't start saving until she turns 60 with the same 5% interest rate, she would have to save $14,700.
So the point is, we really want everyone to get started early. I'm 37, and I wish I started earlier, but I'm sharing this knowledge now, and it's never too late. The time is now. And if you want to book an appointment, go to my calendar, book an appointment, and it'll be with myself. And in those Canadians will be with Paxton Fritch, and Americans will be with Andy Pham. So I hope that you learned something today. I learned a lot today about these funds and where to find them, and this was a great video. So thank you so much. Please book your appointment with me, and I hope to see you in another video soon. Thanks a lot. You're the best.